Our last two chapters deal with securities firms and investment companies. Investment banks are banks, but they're primarily focused on helping corporations raise funds through underwriting stock and bond issues. In addition, they advise on mergers and acquisitions. Some well-known names in investment banking include J.P. Chase, Goldman Sachs, Citigroup, Morgan Stanley, Bank of America, and Credit Suisse. Securities firms are considered the retail side. They deal with trades in the secondary market. Brokers and dealers assist with this trading, and they may also make a market in some securities. Charles Schwab and Fidelity are examples. In this industry, size is measured by equity capital. There's been a lot of consolidation due to economies of scale, losses, and scandals, and regulations are allowing more intra- and inter-industry mergers. Scale and scope economies provide pressure to get larger to improve profitability. Several mergers occurred due to scandals at firms, and in the late 1980s, regulators allowed more cross-border mergers. The industry underwent shakeouts in the 1970s after Mayday and again after the 1987 crash. As you can see, the number of firms is declining. Commercial bank holding companies are national, full-line firms. Commercial bank examples include Bank of America and J.P. Chase. These firms' income comes primarily from brokerage, lending, and underwriting and trading activities. National full-line firms specializing in corporate finance, such as Goldman Sachs. Their income is primarily from underwriting, placement, mergers and acquisitions, and other consulting services, as well as trading income. Large investment banks have branch networks servicing institutional clients. Smaller, specialized firms include regional investment banks, which are considered boutiques, discount brokers like Schwab, internet brokers like E-Trade, venture capital firms such as New Enterprise, exchange floor specialists, LaBranch, dealers in off-exchange trading, the best known being Knight Capital Group. This slide details the various lines of business of investment banks. IPOs and SEOs are their primary areas of focus. We've looked at both of these in previous chapters. To review, an IPO is an initial public offering, the first time a firm offers stock for sale to the public. An SEO is a seasoned equity offering, when a firm which already has shares publicly traded offers more shares for sale. Private placement is more common in the bond market when an offering is placed with one or a few large institutional investors. This saves time and cost as less registration is required. A public offering is just that, offering shares or bonds for sale to the general public. We looked at both of these two methods of underwriting in earlier chapters. Best efforts is just that. The underwriter makes their best effort to sell the total offering, but no guarantee. Firm commitment means the underwriter buys the total offering, thus guaranteeing the sale. This is example 16.1 in the text. Murray is offering 20 million shares. The underwriter is making a firm commitment and buying the shares for $15.50 each for a total of $310 million. If they can sell the shares for $16.35, that totals $327 million for a profit of $17 million. If they can only sell the shares for $14.75 each for a total of $295 million, they lose $15 million. The risk in a firm commitment is borne by the underwriter. In either case, Murray receives the $310 million. Continuing example 16.1, suppose the underwriter agrees to a best efforts offering, charging a fee of 37.5 cents per share. In this case, only 18.4 million of the 20 million shares are sold. If they sell at the purchase price of $15.50, the result is $285.2 million. The fee is $6.9 million for a net return to Murray, the issuing firm, of $278.3 million. If the shares sell for $14.75, the result is $271.4 million. The fee is the same, $6.9 million. Murray only receives $264.5 million. Venture capital focuses on financing startups and high-risk firms. The pool of funds is managed by a professional manager. The VC usually buys an equity stake in the startup and is actively involved in the management. Institutional VC firms look for promising new firms. These arrangements can take the form of limited partnerships, financial VC firms, or corporate firms. Private equity differs from venture capital firms in some significant ways. Rather than pooling private funds, The private equity firms sell securities to raise funds. Private equity firms tend to focus on more established firms rather than startups. During and after the crisis, however, there have been fewer promising startups, so VC firms have begun engaging in private equity-type investments. Angel venture capitalists are very wealthy individuals who invest in startups. Market making is the act of making a secondary market for a securities issue. Making a market means being ready to buy or sell a security at a price, and a quantity can be specified. It's not open-ended. Frequently, firms involved in an IPO or SEO may also make a market to encourage secondary market activity in the issue. An agency transaction means acting on behalf of customers. Principal trading is trading for the firm's own account. Trading simply involves taking an active position, buying or selling, shorting. Position trading means taking long-term positions. Pure arbitrage attempts to profit from price discrepancies. Risk arbitrage attempts to profit by anticipating coming news, usually about a merger or an acquisition. We talked about program trading in earlier chapters. It has 3 characteristics: simultaneous buying and selling of at least 15 different stocks valued at $1 million or more. Stock brokerage is trading for customers. Electronic trading lets investors trade using their computers, iPad, or phone. It has gained enormous popularity, allowing investors more control of their trades. Continuing lines of business of investment banks and securities firms. Investing involves managing pools of customer funds in both open-end and closed-end mutual funds. The firm can act as agents for their clients or trade for their own account as principals. These firms also offer cash management accounts, which offer check writing privileges. Besides working with firms to issue securities, investment banks are actively engaged in advising firms on mergers and acquisitions. This can involve finding merger partners, underwriting new securities by the merged firms. They can help assess the value of a target, advise on the terms of a merger agreement, and on the other side, help a target firm prevent a hostile takeover. M&A activity, mergers and acquisitions, hit $1.15 trillion for the first 9 months of 2016, and this is a large source of income for investment banks. Table 16.5 lists the top 10 M&A firms in 2016 ranked by dollar value of the merger completed in the U.S. Topping the list, Goldman Sachs, closely followed by all the big players in the M&A field: Bank of America, Citigroup, Morgan Stanley, Barclays, J.P. Morgan Chase, and Credit Suisse. Panel B lists worldwide mergers. No surprise, Goldman Sachs is still number 1, with the same set of players reordered slightly, a testament to the strong involvement of U.S. investment banks worldwide. Other services offered include acting as a custodian for securities, clearance and settlement, escrow, and research and advice. Fees for these services are often bundled together and allocated for different activities. Investment banks are also making inroads into traditional commercial banking areas. The investment industry definitely moves with the economy. Commissions fell drastically after the 1987 crash. Come the mid-2000s, commissions rose again and then fell during the 2006-2008 subprime mortgage collapse. Finally, since mid-2010, commissions have been rising again. This chart reflects those ups and downs in security industry profits. In 2008, the industry reported net losses of $34.1 billion as revenues fell by over 38%. Expenses fell as well, particularly because with the lower interest rates, interest expense declined. Trading and investment account losses for the industry were $65 billion. As a result, employment in the industry fell from 869,000 to 840,800, and employment kept falling to 779,800 in September 2009. Profits rebounded sharply in 2009, reaching a record $61.4 billion. Commissions, fee income, and trading profits all rebounded, and interest expense remained very low as the Fed kept interest rates down. High profits helped in rebuilding capital and efforts to raise external equity. As you can see, on the asset side, broker-dealer assets are concentrated in receivables from other broker-dealers and securities purchased to resell. On the liability side, heaviest in securities sold under repo agreements. The SEC is the primary regulator of virtually everything in the securities industry. It sets the standards and rules governing underwriting and trading. And SEC Rule 144A defines public offerings and private placements. The National Securities Markets Improvement Acts of 1996 served to reaffirm the SEC's primary regulatory role. It also prohibited states from requiring state registration of federally registered securities or of imposing significant restrictions on private placements. Here's the big one, Sarbanes-Oxley Act of 2002, SOX. It's also discussed in Chapter 8 relative to the stock markets. Sarbanes-Oxley created an independent oversight board within the SEC that increased penalties and forced much more extensive financial disclosure, as well as avenues for shareholder recourse. This was the result of a series of huge scandals, Enron, WorldCom, Tyco, all related to deceptive accounting practices. Within the securities industry, there are two self-regulatory organizations that oversee day-to-day operations, NYSE and FINRA. The USA Patriot Act of 2003 requires that firms identify, maintain records of customers, and verify that they are not on a terrorist watch list. FINRA is the Financial Industry Regulatory Authority. It's an independent, not-for-profit organization, and as you can see on the slide, FINRA performs a number of important functions to keep our markets safe. They're involved in the day-to-day regulation of trading practices. They write and enforce the rules governing the activities, and they examine firms for compliance. They foster market transparency, and they do a lot in supporting investor education. They have a lot of educational materials available to help investors understand different elements of the markets. The formal name is the Wall Street Reform and Consumer Protection Act of 2010, known more widely as Dodd-Frank. This act primarily focused on improving safety and soundness, but it has other aspects such as consumer protection. The Financial Services Oversight Council is charged with limiting systemic risk. Increased oversight of the securitization process to mitigate the problems that arose with the subprime crisis. To this end, Dodd-Frank increased oversight of OTC derivatives. And it established the Consumer Financial Protection Agency, charged with protecting consumers from fraudulent financial activities. The U.S. Congress does exercise congressional oversight in several ways. The U.S. Senate Permanent Subcommittee on Investigation has a broad mandate to recommend changes to U.S. law to protect the public. In the spring of 2010, this subcommittee was focused on the role of investment banks in the financial crisis. In particular, the investigation focused on banks who bundled so-called toxic mortgages and sold them as AAA rated to investors. The last oversight we'll look at, the SIPC, the Securities Investor Protection Corporation. The SIPC was created after the Securities Investor Protection Act in 1970. It's funded by premium contributions from member firms. If a firm is a member, you'll see the SIPC designation on their website. The SIPC protects investors from losses up to $500,000 due to security firm failure. It doesn't protect against bad investment decisions or bad advice. Securities firms and investment banks are very involved globally, with the U.S. firms seeking to expand internationally. Many firms are now engaging in strategic alliances with foreign partners. For instance, Morgan Stanley sold a 20% stake of its firm to Mitsubishi UFJ in 2008. This graph shows foreign transactions in U.S. markets. The black line is stock, the blue line is corporate bonds. Notice how stock rose in 2007, then dropped in 08-09 while rising again in 2010. Bonds were basically flat until about 2010 when they rose significantly. This chart is the other side, U.S. transactions in foreign markets. The black is stock, the blue is corporate bonds. Here, note the jump in foreign stock in the 2005-2008 time, and then the drop and recovery. Bonds increased fairly steadily over the whole time. Table 16.8 details the value of international security offerings. On the top, all international offerings by type. On the bottom, international offerings by U.S. issuers. Straight debt is the largest in both cases. And this ends Chapter 16.